Hi friends, myself Subrata Mukherjee and you are watching my channel Dr. Subrata Mukherjee Distance Learning in Commerce. Today we are going to discuss another problem on depreciation. This is lecture number 12 and you can find the other lectures in the playlist section of the channel. I would like to request the viewers to subscribe my channel. I would like to request the students to note the problem with solution in your notebook. On 1st January 1999, machinery was purchased for rupees 25,000. On 1st June 2000, additions were made to the amount of rupees 5,000. On 1st March 2001, additions were made to the amount of rupees 3,200. On 30th June 2002, machinery of which the original value on 1st January 1999 was rupees 4,000 was sold for rupees 3,000. Depreciation is charged at 10% on original cost. So the machinery account for the years from 1999 to 2002. We have to do the working for the purpose of calculation of depreciation of the machineries over the year. Now, two important things you have to look into. Number one is the accounting period or the accounting year. Your accounting year can be from April to March or it can be a calendar year. So in this question, your accounting year is the calendar year. And number two is the mode of charging depreciation. Mode of charging depreciation. Here, straight line method is adopted. So now we will do the working. Now you try to follow the way I am doing it here. So machinery 1 on 1st January 99, a machinery was purchased for rupees 25,000. It is given that on 30th June 2002, a part of this machine will be sold, the original cost of which was 4,000. So the machine which was purchased on 1st January 1999, the total cost of machine is rupees 25,000, but it has two parts. One is 4,000 and the other part is 21,000. Why we have segregated the total cost of 25,000 into two parts? Because the part 1, this part will be sold out on 30th June. So for the purpose of calculation of the profit or loss on the sale of this machinery, we have to segregate here at the time of purchase, that is on 1st January 1999. Now there was no more transaction during the year. So on 31st December 99, we have to charge depreciation at the rate of 10% on the original cost. Since these two machines was purchased on 1st January, so the depreciation will be charged for the entire year. So depreciation on machine 1 is 400 and that of machine 2 is 2,100. So on 1st January 2000, your written down value is 3,600 and 18,900. Now it is given in the question that on 1st June 2000, another machine was purchased. So I name this as machine 3 or M3. So on 1st June 2000, the cost of this machine is rupees 5,000. Now there is no more transaction during the year. So on 31st December 2000, we need to charge depreciation at the rate of 10% on original cost because straight line method of depreciation is adopted here. So on M1, we are going to charge rupees 400, 2,100 will be charged on M2 and depreciation on M3 will be charged for 7 months. So 5,000 into 10% into 7 by 12. You will get 292. I will do the working here for your understanding, this is 5,000 into 10% into 7 by 12. So what is the written down value of the machines on 1st January 2001? So the value of M1 is 3,200, value of M2 is 16,800, and value of M3 is 4,708. Now on 1st March 2001, another machine was purchased. So I name it as M4. And the cost of this machine was rupees 3,200. Now you have to charge depreciation on 31st December 2001 at the rate of 10% on original cost. So 400 will be charged on M1, 2,100 is charged on M2, 500 is charged on M3, and on M4 depreciation will be charged for 10 months, as this machine was purchased on 1st March 2001, and you will get a depreciation of 267. This is calculated as 3,200, multiply it with 10% and multiply it with 10 by 12, as 10-month depreciation is charged on M4. So the written down value of the machines on 1st January 2002 is 2,800, 14,700, 4,208, 2,933. Now on 30th June 2002, M1 was sold out. So you need to charge depreciation up to 30th June 2002 on M1. So this will be 200 because depreciation is charged for 6 months. So 4,000 into 10% into 6 by 12 is 200. So the written down value of the machine which was sold on 30th June 2002 is 2,600, and this machine was sold for rupees 3,000. So profit made on sale of M1 is rupees 400. Now there was no other transaction during the year, and depreciation will be charged on 31st December 2002. So on M2, 2,100 will be charged as depreciation. On M3, 500 will be charged as depreciation, and on M4, 320 will be charged as depreciation. So the written down value on 1st January 2003 will be 12,600, 3,708, and 2,613. Now you can see the entire working in one screen. So I have prepared the structure of the machinery ledger. On 1st January 99, machinery was purchased for rupees 25,000. So in machinery ledger I am writing here on 1st January 99 to bank account 25,000. And on 31st December 99, depreciation was charged on this machine for rupees 2,500. You can see in the working, the machinery cost rupees 25,000 was purchased on 1st January 99, and depreciation for the whole year, that is 400 plus 2,100, sum total of these two is 2,500. So depreciation is charged for rupees 2,500, and the balancing figure is the written down value, which is 22,500. So on 1st January 2000, to balance BD, is 22,500, and on 1st June 2000 machinery was purchased for rupees 5,000. And again on 31st December 2000 you need to charge depreciation. And what is the amount of depreciation? On 31st December 2000, 400 plus 2100 plus 292. So 2792 is the amount of depreciation charged on 31st December 2000. So we will write here 2792, and the written down value on 31st December 2000 will be 24,708. If you add up these 3,200 plus 16,800 plus 4,708, it will get 24,708. Now on 1st January 2001, to balance BD, this is the written down value, that is 24,708. Again on 1st March 2001, purchased machinery for rupees 3,200. And on 31st December 2001, depreciation was charged. Now what was the amount of depreciation on 31st December 2001? So this is 400 plus 2,100 plus 500 plus 267, and you will get 3,267. So 3,267 is the amount of depreciation charged on 31st December 2001, and the balancing figure is rupees 24,641. And if you go to the working, the sum total of these four items, you will get 24,641. So total of debit and credit side is 27,908. Now written down value on 1st January 2002 is rupees 24,641. On 30th June 2002, you need to charge depreciation for rupees 200 because this M1 was sold out. So depreciation charge on 30th June 2000 is rupees 200. So I have to write here buy depreciation 200 on 30th June. Then on the same day, this machine was sold for rupees 3,000. So I have to write a bank account debit to machinery rupees 3,000. And you made a profit of 400 rupees. So machinery account debit to profit and loss account rupees 400. And on 31st December 2002, depreciation was charged on the remaining 3 machines, which is equal to 2,920. If you add up these 3 depreciation of the 3 machines, you will get 2,920. So I have to write here buy depreciation on 31st December 2002, 2,920. And the written down value of the remaining 3 machine, if you add up these 3 written down value of the 3 machine, you will get 18,921. So the written down value of the 3 machine on 31st December 2002 is 18,921. So you can see the machinery account in one screen. Hope all the students have written the question with solution and have followed the way I have adopted here for solving this problem. If you find any difficulty in understanding, feel free to contact me through email and phone number given in the description box. Thank you. Thanks for watching the lecture.